Hello and welcome, everybody. I hope you can hear me okay. I'll do a quick sound check. Um, I'm just admitting everybody as I go in. Um, just let me know in the chat box just which city you're from, so I get an idea of where where everyone is from today. So we've got some people coming in now. We've got more starting. So I'll just keep running through this. If you'd like to just quickly give me in the chat where you are, give me an idea of just uh, um, London, Zurich, lots of different places. That's good to hear. Um, Tokyo, it must be a reasonable time for you. Spain, we're all over the place. That's good. I'll just quickly try and get us all into this, and then I'm going to run through this as best I can. Today is probably an hour, and I thank you for giving me the time for that. I'm going to run through just how I can best make the most of this for you. I'm going to share my screen and then walk you through about an hour of not intensive, but it's good quality content that you should be able to walk away from this session and apply this to any innovation you have at the moment and start to get momentum in your project, which is the most important thing here. Um, so I'll just quickly share my screen. There we go. You should be able to see my my screen now. Just let me know if you should be able to see finding commercial partners. If somebody wants to unmute their mic and just let me know, or just in this in the chat box, just let me know you can see that. Okay, I'll just I'm getting my menus ready so I can mute everything and hide all my menus away. It's going to be important for us to be able to get some traction here. Okay, clearly visible. Excellent. Okay, we've got all of that. I'm now going to just try and get you what I can see here in terms of finding commercial partners, and we'll get started. Now, my name's Daniel O'Connor. For those of you who don't know, I run the Inventors Academy. We run from Kickstart Plus, which is based in it's actually based in Van Nuys in California, but we also I operate from here in Perth in Western Australia, the world's most isolated capital city. So if I talk a lot, it's because we're lonely here. We only got 2 million people, and the nearest town's more than 2,000 kilometres, 2,700 kilometres away. So, okay, so let's get started, shall we? And if you're here, there's a strong chance you've either got you're an inventor who's stuck for longer than you expected, or perhaps you're a new inventor who's already sensing that the traditional funding advice that you've got doesn't quite add up for you. If that's the case, tonight's not about motivation, it's not about belief, it's about removing the single biggest blockage that I see in early stage commercialisation. I've been doing this now for over 40 years, so sorry, my throat's a bit dry here. I've been running along very hard all day. Now, the whole idea here is we're going to try and I see these blockages around the early stage commercialisation. And if I explain what early stage commercialisation is, I categorise that from starting post ideation. Ideation is when you've locked in your product. You now know what you're going to have. You know all the iterations of it. You know what you're going to commercialize, and it's locked in. It may not be finished, but it is locked in. And at the end of the journey, I've hand you off to pre-scale. Pre-scale is where we're ready to scale a project. At pre-scale, we can hand you off to venture capital, private equity funds, etc., because you have the four things they need, which is starts with high growth. Second is cash flow. Third is you're in their silo of operation. And fourth is you know how to talk to them, in as much as it's very important for them to know that you can negotiate with common sense. A lot of inventors can't, unfortunately. So please understand that what we're trying to do here is to give you the leverage to walk into a meeting with a venture capitalist when you have that cash flow and do a deal to scale your business. At scale, those sort of companies will look at you and say, if I put 10 times the equity into that, I can get 100 times the output. Would you like to share that with me? I'm prepared to do it if you'll share with me. And in most cases, the first thing you'll say is, of course I will. So what we want to do is get you to that point. And we do that through teaching you how to do it and then walking you through and holding your hand all the way through for until you get your first significant cash generating transaction, which we're going to try and do in 100 days. We usually start with a modest cap raise, but we also do the same thing for distribution, licensing, and trade sale. All four of them pretty much have the same thing, even though they're radically different. They have the same methodology to get it done. Sounds crazy, but you'll actually understand it as we go. So this is all about finding you willing commercial partners. So if I just step at this through now, by the end of this session, you will understand why chasing investors is usually the wrong strategy and how Inventors has shifted the commercial partners model. They move faster, they raise less money, but they don't need as much money, and they keep control of their projects. I'm going to show you why investors stall inventions and partners can move forward, which is important for you to understand. This is all based on my doing this for the last 43 years, as I mentioned. This process I've had people use on more than 3,700 projects in the last 40 years. And we've handled upwards of $1 billion in estimated long-term revenue. So you can understand it's well and truly locked in. Any of these projects started more than 100. I've had $100 million projects. I've probably had about 4 of them. Most of the projects have been under $1 million in valuation when they come to me, and we take them and ramp them up. We'll show you how to do that. I want to show you how this whole process unlocks the single biggest blockage that you'll have, and I'm going to show you how your success will start with the who rather than what you want. The who is the people who will partner up with you. We don't go for investors, but we pick our partners very well. And if you do that right, you'll start to get leverage and power. Because right now, when you walk in front of investors rarely have any power at all in the conversation. So what I want to do now is talk about the inventor trap. We all think to ourselves, if people see a good idea, they're going to fund it. That's usually the first thing we think. And from there, we start to get a product obsession. And we think that everyone who looks at our product will like it just as much and have the same emotional attachment we have. And if they feel the same, what are they going to do? They're going to have to invest in it. All I need then is 50 investors at, let's say, $500,000 each, and I've got everything I need all the way through to profit. That really works. Another thing we think of when we start to talk to investors is I can get the global total available market might be $1 trillion, and I just want 1% of that, and we're all going to be wealthy if I can do that. But the fact is, you don't ever have enough money to do any sort of marketing to get 1% of a market, a global market. So that really, people will scoff at that. So if you are thinking that, just bury it. It won't happen. Now, I can tell you now there's a lot of very clever inventors out there, but they're making these assumptions on almost a monthly basis. They keep repeating them with different projects. And as they do, they wonder why the project is so hard to get off the ground. You may be an expert in science, in engineering, pharmacology, whatever your field is, but that doesn't make you an expert in commercialization. And I'm going to try and give you some of the expertise today that you can use on your project. When you walk away from this call, you can apply some things straight away to make the difference in your product or in your project. Now, the conventional capital models are the usual $500,000 for 50 investors. I've got everything I need all the way through to I can get this to profit in 3 to 6 years. If we don't make profits, what happens? The project gets diluted. that means I dilute, not my other shareholders, only me. So if that happens, I've crashed, and I'll end up with 5% to 15% of. I've had a project which did that. The guy funded it. He should have funded the capital expenditure, but he didn't. And as a result, because he was leasing his equipment out once he built it, and as a result, when he came to me, he owned 6% of the company, which he should have owned 100% of. So anyway, that can happen. We don't want that to happen. So what we're trying to do is fund all the way through to first cash flow. Once you have cash flow, it starts to get easy because you can reinvest that cash flow and to grow the project out. There's very few investors or even private equity funds who will fund you all the way to through profit. There's no possible way of them doing that because it doesn't make sense. It's too much risk. They'll be in it too long, and their risk factor, they won't be able to add sufficient value to mitigate their own risk. So most inventors want momentum. They want a rapid change. And if you can't deliver it, they're not interested. Well, I'm going to show you how to create your own momentum and still own the project. Now, this isn't not being naive. It's that old style is outdated now. It wasn't that we were being naive about it at all. It's just that that's the way it was. And so what I want to do is change the model, completely flip it around. And first, we have to understand what it is that nobody talks about. Things like, for instance, you get an emotional commitment to your project, you're not going to talk rationally to investors. And in fact, if they disagree with you, you're going to argue with them. And that can be quite painful at times. You're also going to have a financial commitment in there. And as that grows, or as that the time ages that financial commitment, it's going to get harder for you, harder for your family, harder for the people who you work with and work around you. And they're going to have to make more adjustments to you as you get more and more brittle because things aren't working out. You get personal time constraints. As your project isn't working, what do? You double up, you double down. So as a result of that, you're taking more of your personal time and throwing it at the project. And that's not exactly a key to success. So what we want to do is we want to accelerate it, and we want to look at any which way we can. And usually that means we double down because we either double down in funding or we double down in effort. And if we do either or both of those, it's going to cost us personally. And we're doing this, we're rushing this because of one thing, a need to prove that we were right in the first place. And it becomes a challenge, and that can cost you money. I'm not in that. I'm in here to get you to cash flow positive, and then you reinvest what you've got to get more cash, and roll it on until you get to that pre-scale stage. So now, if you wanted to just drip feed this and do a little bit of cap raise, run out and go and do something else and raise more capital and do something else, that's trickle feeding, trickle funding. It's a guaranteed failure in most cases because partial funding always kills projects. It means that you're forever doing capital raising. You're also diluting without any momentum because you won't have any milestones that you meet. You can promise them, but once you haven't met them, you need more money. You're diluting yourself. Most people will have a non-dilution in there in terms of your investors, certainly with early stage, to prevent this from happening to them anyway. Meanwhile, of course, the longer it all takes, your admin expenses still keep going. That includes your fee you take out of the project as you develop it. All of this costs money and it eats it. So time will eat your savings as well as your previous investments, so your investment money you've received. So you then take on another role, which is called investor relations. What happens with that is you have to, and I've known somebody who had to spend every Monday morning with his shareholders on the phone. He had about 50 shareholders. He was a public company about to list it. And he spent Monday mornings, for some of them he caught up with on the golf course. The rest of them, he was Monday mornings. How's it going? He had to explain them. And that becomes a legal issue because if you explain one thing to one person and something different to another person, you're actually breaking the law in some countries because you're actually withholding information by not telling them absolutely everything and the same of everything. So you can end up advantaging or disadvantaging somebody, and that can come back and bite you. Now if you run out of money, it's on you. As I mentioned, the dilution is yours, not the investors. They won't accept dilution, and usually they have something in there to prevent that. So ultimately, the whole process of funding becomes a slow erosion, and it's an erosion of your capital in the project. So what changed? Well, this has always been going like this, but about 2008, the world ran out of money and spending, and there was no luxurious spending. Nobody was overspending. We started pulling back. But in 2013, the funding behaviour shifted. The big venture capitalists started going to larger projects, and they left the little guys. But while that happened, while the funding behaviour shifted, the investors didn't. And so the investors were still looking for projects, but only at bigger stage. And that meant you can't do anything about it. In the meantime, of course, they're moving the risk back to the small guys for any project that looked promising. And that meant the risk moved back to you. And that's where you dived into friends and family. So your first round of investment might have come from friends and family or your own savings. Then you start to move into private investors, and then you start to move to venture capital. Or what we've done is change that model to give you a little bit of risk mitigation by controlling it with partners, one partner. The capital that they started giving out became defensive. They wanted to know there was a focus on the returns, not on the potential. So they really held you to your feet to the fire. And if it didn't happen, there were usually penalties built into this. And in the past, where we go to a pitch fest and we stand in front of a crowd and we make claims, and the guy in front of you and the guy behind you made bigger claims in order to get more attention. That sort of thing fell over. It stopped working. People just didn't buy from that, and I don't blame them. Because a lot of it was replaced later by crowdsourcing and crowdfunding, but that's beside the point. But what I did in 2013, I invented the Cornerstone Investor model, and I'm going to explain how that works for you today. It's not just for investment. The Cornerstone Investor model works for securing distribution, licensing, and even if you wanted to sell the technology outright or the innovation, they can do this through a trade sale. So what we look for these days, we don't look for a whole heap of investors. We look for one single industry or market-based investor, somebody who's in the industry, in the market, understand all the risks, and can leverage some advantages they have from being in the business to diving into your project. And that capacity to leverage their services means that you need to raise less capital if they're going to give you access to some of their services, their plant and equipment, their sales channels, everything else that you would spend the money building. So the moment the funding models changed was quite a big thing. It was the turning point in my own work, I can tell you. We use the same project, same inventors, different target completely. So we went from pitching hundreds to closing one from just 4 pitches. And we did that using our 10-4-1 model, which I'll show you later on in this. We tried to apply the scale model, and those investors had safer choices when they did that. So we took you all the way to scale and then handed you off. What I started doing instead was partnering someone in the industry, someone from the industry or the market who had all the infrastructure you needed. We were trying to ask them for funding to first cash flow event. We didn't want more than that because we didn't want to dilute you. We were looking for people with existing infrastructure or market share, and we wanted to give them a bigger slice of a smaller pie. So, for instance, if you were based in one city or county or state, you might say, I'm going to offer you 50% of my business in this area. And that's all the business that you deal with at the moment. So it's going to advantage you completely, but it doesn't give you any rights outside of that county or state or country for that matter. And therefore, I'm holding back the bigger pie for myself. And people don't mind that if it's spelled out. I have had people come back to me and say, well, why can't I have this bigger? And I say, well, I'm offering it to you in a small area, a limited jurisdiction, because I want to save you money because you can't afford the big one. So that way, it costs them less cash. it's also far more reduced risk for you and for them. So the Cornerstone investor model is now flipped it completely. We ask different questions. No longer do we ask who will invest. It doesn't matter anymore. But we target who we're going to invest in, who will benefit from this existing project, from their existing project to use our process. So it's an industry embedded value, if you want, if you like. So let me take it through just give you a quick comparison of investors versus partners. Investors, they're passive, they're ROI driven, they're fearful, they have spare cash, but they want to place it as best they can and get a quick return. They're high risk assessment, so they go to accountants, they go to their advisors, financial advisors, they get a lot of risk assessment from third parties who you have to convince in order to get this project as well. Their risk converts to returns and they need to offset those, and there's no offset for them. So returns is everything about offsetting their risk. They want a clear pathway out. They need constant feedback. And most importantly, you need a clear exit path to get them out of your business at the end of it. And how do you do that? You either pay them out through your earnings, and bear in mind, you don't own all the earnings while they're in there, or you have to find another way. Now, if you deal with partners, it changes it completely. Firstly, you contain the industry risk because these people know what the risks are. They're already in the industry. They know what those risks are. They're going to add experience, know-how, knowledge, everything you need to understand how to jump into this business. They have access to assets, like, for instance, sales channels, plant, equipment. I've had a guy recently that got given a corner of a factory. He got access to a forklift, a gantry crane, laser cutters, welders, the people welders, and also welding equipment, racking, everything he needed to put his project, a CNC press, everything he needed to put it all together. So he didn't have to go out and buy that equipment. That took his investment from $500,000 to $88,000. That just shows you how quickly it can change the game. They also can become early buyers if they've got an existing sales channel that you can, for instance, if they're selling burgers and you're building fries, you might say, well, my fries go well with your burger. Let's go out there and sell these alongside yours, the same channel. So you might pick someone with a similar channel, but also they may have past clients who have bought their product, but could also now go back and buy this. So imagine if they sent out an email saying, you bought our M2000 back in 2014, would you like to have a look at this? And we'll sell you one. We'll give you 30 days a free trial and pay for it at the end. We'll send it out to you on Thursday. Would you like that? Tick here and let me know. And it's a quick and easy sale. You might, particularly if you've got a database of thousands, you might get hundreds of sales and they might be millions of dollars, and you'd be off and running before you even start. They also can reduce the actual cash requirement. As I mentioned, access and assets, plant and equipment. All you really have to have is the money you're going to spend on yourselves in terms of keeping yourself going. Sometimes they're also able to give you people within their organisation, so you're not paying for the labour. So what we do is we offset that by giving them equity in exchange for that. But it means they don't have to come up with cash. It's an easier decision for them. And also, they can become the exit option you're looking for both sides. So if they own half a business, local business, with you, then when the time comes for you to go global, you might say, well, I'm going to go national now, but would you like to buy the other half of my local? And they buy that. You've got, basically, it looks a little bit like a franchise, but it's actually a license in perpetuity. So usually we do a unfettered in perpetuity license, so they can have that and do with it as they wish, providing they don't crash the project or product. Now, we don't aim to get you to profit because that's too far down the track. Profit usually comes after you scale a project, and that's way too long for most investors. The people we're dealing with are partners, and they're not big fish. They're usually a small, successful number 2 or number 3 in the business, in the industry, and they're trying to struggle to get a little bit more. So what we're looking for is cash flow plus momentum, because that's going to beat any sort of forecast that we would do as a substitute for our pitch. They can understand we'll get to cash flow, and they understand we can repeat that, and that's the momentum they need. So the risk goes from the first cash flow, and beyond that, all we're doing is building momentum till we sell this project, or we trade sale, or get to early stage, or to pre-scale. So for most cases, people say, well, when will you get to profit? It's not relevant, because profit is a vanity metric. And if I explain that a little bit better than as a term, I can tell you that profits is always offset by growth. So you can't have growth and profits. You can have minor profits and major growth, or minor profits and minor growth, or you can have major profits and no growth. You can't have major profits and major growth. It's really just not. Growth needs money, and so you're going to have to pour it into that. So, but momentum changes the metric completely. It creates optionality. People understand that, and the people you're dealing with as partners fully understand it because they understand the risks involved. We're also reducing the risk because these people are across the industry or the market, and they understand what that is. But they also, it might give them growth and it might give them momentum, and that's all we're looking to do. So if we can give them a risk reduction with growth and momentum, that's our story, that's our pitch. Your early stage goal is to pre-scale, it's not to profit. So, and that's their exit, your exit. It might only just be a value realization point where you both stay on board, but at least you can afford to take the option if you wanted it. You don't have to take it. Now, everyone wants to fund you at that point at the pre-scale, because right then you've got cash flow, you've got high growth, you've got everything that they need to say, well, this is going into the clouds. It's time for me to put some money in it, and I'll get better money out. Why not? So your objective then is cash plus momentum, plus the industry, plus a partnership experience with somebody, an experienced partner, to jump on this and do it. This is why VCs don't touch early stage innovation. It's just too much risk. And they also, I don't know whether you're aware, but most VCs and private equity funds are formed under legislation in their respective countries. And in most cases, their requirement is they cannot invest in anything that doesn't make a profit. And so that way they're pushing you to make profits when you're wanting to offset that against growth. And that can curtail your business somewhat too. Now, how partners think is a little bit different from the way an investor would think. Your prospective partners already understand the risks in your project, often better than you do because they've been in the business. They live these risks every day. What they're evaluating isn't return, it's their leverages that they have. So you have to stop thinking about return on investment and start thinking in leverages. And I'm going to explain what they are. They should already understand the risks, as I mentioned. They've got price benefits against internal costs because they know that they can get economies of scale if they add in your particular production facilities into theirs. So they're increasing, they might take their production capacity from 60% to 95% by adding you in there. That's going to make their operation far more cost efficient. Even though it's increasing the cost minor, it's going to make a lot more profit. And they can take that profit and to their bottom line. So it's helping their business as well as yours. This is why inventors misjudge them. They don't understand that. They think they need to see the leverages in order to understand how this is going to work. And if you know what those leverages are as an inventor, you won't misjudge these opportunities when they come from players in the industry or the market. Now, what we need to do is to monetize those leverages. So what we need to do is identify what they are. Then we need to monetize them so we can add up what they're worth. And then we need to stack that value so it can be more than the investment that we require. So, and that means that there's an equity percentage of geographic on demographic. So they might be in the automotive industry, and we might say, well, we're going to give you exclusive rights on cars, but not buses and trains. And therefore, and we're only going to do it for the state of California. We're not going to do it for the whole of USA. In which case, okay, you're only dealing in California anyway, so we'll give you a bigger slice of that smaller pie, even though it's not a small pie, but you can understand it. So what they're evaluating really isn't the returns. They're evaluating the leverages, and that's the important part. Now, leverages don't cost you money. This is value that you can offer that costs you nothing. It's access to plant and equipment. So what you want to do is raise the money to go and buy plant and equipment. Well, guess what? If they've got it and they give you access to it, that's money you don't have to raise in cash. It's access to sales channels. I did one a couple of months ago, which I mentioned in one of our previous webinars, where we classified the existing sales channel as $110,000 it would cost us to make one, and we didn't need to. These guys had it; they had the network. We could tap straight into that, so it saved us $110,000. That was the same one. We went from $500,000 to $88,000. They might have skilled tradesmen, welders and welding equipment and everything you need. They also might have economies of scale and parts. So you may find that I've had one recently, which was a brilliant little machine. I can talk about it because it's patented. These guys mixed a leaf blower with the oscillator from windscreen wipers. And basically they blew air across a pathway when it was snowing, and they cleared off the snow as it fell. Therefore, they could keep the driveway clean. Very quick, very efficient, very cheap. And in order to do that, they went off and looked for people in the leaf blower industry and said, you've got products on the shelves 6 months of the year. We can give you products that you can put into those big box retailers for the other 6 months as well. Everybody was happy. And they also, when they manufacture it under a license, they get economies of scale on those same components that they're using. We've had lost sales recovery where we've had one guy that said, why don't you, before we did our pitch, we said, we want you to do some homework. We said, go and look at all the sales that all the quotes you've done in the last 12 months that you didn't get. And we want you to go back to them and ask them, did you buy from someone else? And see how many of them didn't buy. And in this case, it was for installation costs. And this guy eliminated installation costs for that particular line of products, and he changed the industry as a result. So what these guys did, when we sat down to them, we said, did you do your homework? Yes, they did. How much? He said, we stopped counting at $2.5 million. And we said, $2.5 million worth of sales? No, that's $2.5 million worth of potential profit. So they knew that if they could eliminate that, they would get some of those sales. That's all they needed. They knew they had a winner. So all of this is non-cash, of course. It's strategic, it's unique, and it all has value for you. They might have office, factory, warehouse spaces, I mentioned before, and that can total more than you actually need. And in doing that, you can offset all of their costs that you're asking for them to give to you to nothing. So if you're asking for $500,000, put $500,000 into my company so I can go and buy the same equipment you've already got, doesn't make sense. But you're prepared to give away that $500,000 in value if you get access to the equipment you need for that point. It may be less because you're not buying it, you're just using it. So you can see how this can work for you. But what we have to do is find the right partners, the right economic partners in that industry or market. And the way we do that is a process we call 10-4-1. It's a search discipline we've been using now since about 2016, and it's worked really good. What we do is we look for industry players and we build our 10 prospect lists, a list of top 10. These days, AI does a lot of this for you. It's very easy to get, you ask for the top 10 in this particular industry who do this and do that and have this problem, and they're not number one. You don't ever want to talk to number one. They'll defend their industry, but not. They won't spend money defending it. What you want is the guy that's hungry. Number two and number three, they want to become number one. They need some sort of sustainable competitive advantage to do that. You may just have that. So once we've got our top 10 that we want to talk to, we then use our leverage values. I have a table of leverages, and I use that to size the offers. So I put it across the different companies, and I check off 14 different leverages and find out which ones are applicable to those particular players in that industry. And that gives me my top 4. Once I've got 4, I only want to pick one, because our cornerstone investor or cornerstone deal is going to be somebody who has the most value out of those 14. When I've calculated those 14, I need to add them and then stack them and show how much over the limit I am. Once I've got a good value, so I might be asking for $250,000 or $500,000, I'm not going to ask for a $500,000. I'm going to show him how I've mitigated at least $500,000 worth of risk. In most cases, it can be well over that. But also then, all four might qualify there, and I don't take the one that's the greatest. I take the one I want to work with because I need to be comfortable with them because they're a long-term partner. It's not a marriage, but it's a long-term partnership. So we do keep the other three prospects warm, so we know we can go back to them, but we only pursue one. And the reason why we only go after one at a time is because we can generally get the first one first. But it takes a lot of effort to do the custom pitch. We do two pitches. One is the narrative and the other is the pitch itself. We call it pitch A and pitch B, using our 12-point pitch framework that I use. That's for one prime prospect. That's all we do. And we add it up. When we come to the page on leverages, we show them the stack. So we show them how valuable it is to them by the time they are ready to. They probably, walking into that meeting, had no intention of investing in anything. But at the end of it, it's a no-brainer. They can't afford to walk away. We align the value and the leverages specifically to their operation so they can see, okay, if I get involved in this, I'm going to be able to have an advantage here. This is going to work well for me in my other business. It's not going to be, and bear in mind, these leverages don't cost the inventor anything. They cost the investor or the prospect very little in terms of a partnership. All they're doing is giving access to it, or it might be sales channels, it might be plant equipment, whatever. They're not going out and buying stuff. So you can see that they can mitigate quite well. Once we've stacked that value, we offset that against the investment and the risk, as I mentioned, and we show the leverages. The leverage value is greater than the cash investment. So we're always targeting back to the cash investment versus the leverage. So you can see how that works. Now, the leverage calculation checklist, I've got one of those. I just want to go over the three dimensions that we cover off. The first dimension is we're looking for people in the market, in the same operational field. They're financial and it's strategic. So we're using those elements to qualify at first round. Once we've done that, we're looking at the second objective, which is what do we want out of this? Do we want funding? Do we want distribution? Do we want licensing or a trade sale? We only look at those four because we know that they're the low-hanging fruit that's going to deliver cash flow for you and give you options. Once you've got cash in the bank, you have more options than if you don't. Believe me, that's where survival is, your first cash flow. The third dimension is their value. What can they bring to you? Can you make those leverages worth more than the investment you're going to ask from them? Do they have assets that you need? Are they people you can work with? Will they accept a bigger percentage of that smaller territory? It's always nice, big slice, small pie, and you keep the big pie for yourself. So I want to just breeze through the who. I have to point out to you that markets buy, but industries enable. Your job is not to convince buyers that you're going from one to another to sell your product. That's a waste of time. It's to align with those people who already serve those buyers. If you can do that, you can find one of those. They can become the commercial partner, and that's who you're looking for. They're the group that will champion what you have and at no cost to you. The where, we've got to find them, and they're not always available. But I can tell you one good spot to find them is at trade shows. In the past, we used to go to pitch fests, but they scatter your attention, the attention of the investors. They generate competitive claims. Trade shows instead are a target-rich environment. If you some trade shows, for instance, if it's not a national or global trade show, the people on that stand from the companies you're targeting ultimately will just be salesmen, and you don't want to talk to salesmen. You want the national or global trade shows because those are the ones that have sent their engineers along, their product managers. They're not on the stands. They're going around and looking at their competitors' products to see who's got something, what's the latest release in this year. And we want to find that perfect partner to offer a big piece of a small pie. If they deal locally, giving them 50% of the rights for their territory is big for them, but it's very cheap for you. Now, how we use those trade shows, we don't sell. All we do is sell an appointment. We never have a trade show stand. All we do is we qualify the trade show. I have a process. It's a complete module in our our program, which is called How to Walk a Trade Show. It's a 7-week program. The first 6 weeks starts 6 weeks out identifying and qualifying the trade shows, and then the week afterwards is how we conduct due diligence in order to get to the deal. But all we're doing at that trade show is getting an appointment. So we walk in there, we're following scripts to get our appointments with them on the trade show stand. When we get there, we're now there to organise a pitch. And we're not going to pitch there, we're going to pitch somewhere else. If you try and pitch on the stand, these people are going to get very self-conscious that you're taking over their stand. They're also, if you take them off the stand, which we try and do, and then pitch to them and take more than 10 minutes, they're going to lose interest. They're going to become almost hostile, because what you're doing to them is taking them away from all those people that are wandering on and off their stand and not getting served. And you can't afford to do that. Some people work in there and say, I've got something to show you, please sign an NDA. That's never going to happen. If you adopt this predatory fishing behavior, you'll just upset people. You'll never get, we call it stalking and talking. But a lot of people go in there and start talking over others, make rash promises. This is where structures matters more than enthusiasm. You're walking in there with 2 15-second videos, which we do. One is, this is what I've got. And the other is, this is how it works for you. And it's not about how the product works, it's how the commercial model works for you. And when we do that, we only show them if they say, well, what's it all about? Tell me. We should be able to pitch it within 5 seconds, but if we can't, we may use one of those videos. And that's it. No NDAs. We don't show them anything secretive. I just want to set up a time to show you how this fits your M2000 or whatever it is you've got on the stand. And you've made sure you qualify them and know what they're going to have on the stand so you can marry your product to theirs so it fits the same channel. Now, pulling all these threads together, I showed you a little bit about our 10-for-1. I showed you how we do our Walker Trade Show, and back for further why you should take the Cornerstone Investor model and use it for a commercial partnership rather than an investor or just finding a licensee. I want to now give you, just bring it all together for you so you fully understand it. If you think you had a funding problem, maybe it's just a positioning problem. That's all it is. If your project slows or stalls, you're losing income immediately, and you always have to keep a project going. You can't get back on track if you don't have a track, and that's another important aspect. You might be an expert in chemical or weapons, whatever it is. You need to understand that doesn't make you an expert in how to do this. And if you don't do it right, you don't have a track, you're just going to meander. What we give you is a structure that shows what needs to be done and when, and we sequence the whole lot, everything, to make sure that everything works. This is what I do, this is what I do now, this is what I do next. Experience coaching is going to help you, and it's going to guide you, and it's going to accelerate the process as you do it. And we do that quite a bit. So inventors rethinking their approach, I can tell you now, this sort of process doesn't work for people who are just chasing validation. Now, I want to talk for about 4 minutes about what we do, and how we help, and then I'll just jump back into this again. So firstly, we have our level 1 program. And we have also an acceleration to the level 1 program. I want to talk about this first. What we deliver is, first we have to teach you the Cornerstone Investor model and everything about the commercial modeling. Commercial model is the most important part of this. It's not your product. The most value is in your commercial model, how that product that you've invented is going to make money, because that's all anyone wants to know. So we deliver that in video case studies and video lessons, all online. Once we've done that, we also give you access to checklists and templates, the SOPs, the scripts, everything you need, proven structure and process. And then you need help. You get weekly help in a group, but you also get one-on-one help. Anytime you need it, you get onto me with our daniel30mins.com, which I'll show you later. And people, you're in my calendar. You make a 30-minute booking. You're talking to me within 4 hours or 7 days. And I'm one-on-one with you. And chances are, whatever the problem you're having, I've handled it a few hundred times. So we also do the group learning with a cohort of 6. We found that by putting people together, we have 2 advantages. One is we're able to reduce the cost and make it affordable. And the other is we find that they solve each other's problems, and they also give you, as an inventor, experience with commercialization across a different one of the 6 steps of commercialization. So you might be on step 4, but you still have to learn steps 1 and 2, and someone else is at step 1. You can pay a little more attention and help that guy, or sometimes you might be able to lean back and help him out of the problems he's got on those calls. In fact, I had a call today, which was from one of my US groups, and from last week, where they said, let's get together. I've got something that I think I can help you with. So that call happened today, and I had 2 members of that group and myself, and we just talked it out. I recorded the entire thing and gave it back to them so they can keep it moving. So that was one very experienced business guy talking to somebody who was an academic with no business experience at all, and saying, you've got a good project. If you go that way, you're never going to make it work because it's very, very big opportunity. But if you go this way, you can slow it down and make it micro instead of macro, and you'll get traction. You'll make profit that way. We also have accountability. We have accountability each week with our Group 6 cohort, where you have to turn up once a week, you or one of your members, and report how you're doing, and we keep you accountable. We also do accountability on once a month called Project Status Review, where in our workshop that we do with you, we do, it's a 4-hour workshop. We start with 244 questions, and it blows out to about 500 data points on a mind map. In that process, we put out an action plan for you. And that action plan might have, the last one I did last week, we had 182 items on the action statements over 6 months. So in doing that, every month, I'll now get online with that guy or that team, and I'll say, here's what had to be done in month 1. Have you completed it? What hasn't been completed? Who's going to do it if you can't do it? And I've got accountability names against each of those items so I can keep someone accountable. So all of that is part of it, because if it's not looked at, it doesn't happen. And the last thing we have is industry contacts. And I was lucky in as much as 2 weeks ago, we had a company, one of our projects looking at a particular company out of Germany, a worldwide organization. And they were in Ohio, and my local guy here in Perth, one of my clients from 23 years ago, is dealing with that same company. And I knew that, so I'm able to put the two together. So sometimes that can help. Sometimes it can't. You never know. So your new focus, if you want to do this, is to stop chasing people who don't understand your risks and start working with those who already live with that risk. That's where you're going to mitigate all the chasing. That's why we can do one pitch, usually maximum of 4 pitches, and get you your funding. You're sharing your risks with industry players who understand that risk far better than anyone else. And why should you be raising funds for equipment that they likely have and therefore you don't have to buy? You're going to give limited exclusivity for local markets. It might be for a limited time, but it might be a limited exclusivity, and you don't care. If you might also offset by selling them 50% of that local market with you. So they're basically buying your project, but only for that area. Once it gets going, you'll move off and go statewide, national, global, whatever it's going to be. You want to dilute the local opportunity, but save the global value for yourself. Now, investors won't understand what your risks are, and they won't understand what that model works, why that model works. But industry partners already live with all of that risk, so they understand it fully, and they'll want to get involved with you. So the transformation that you need to do is you need to transition from technical confidence and competence to commercial uncertainty. And with commercial uncertainty through to a first commercial agreement within 100 days. If you can do that, your project will have the momentum it needs to keep going. So if you have full confidence in your product, you don't have commercial certainty yet, then that's how you do it. We use this program to get your first commercial agreement within 100 days and then carry on for your second or whatever you can do within the 6 months of the program. The measurable outcomes are pretty easy. We sit down and give you 1 qualified commercial partner engaged, 1 written commercial offer on the term sheet, no overspending on tools, design, prototypes, patents, anything that can be put off to later, because let's face it, you may need all of that, but why should you pay for it when the project can afford to pay for it later? Why you need to become a member is pretty easy. This converts your paper asset, your patent or whatever you've got, into a monetizable commercial pathway. It avoids that 12 to 24 months. Sometimes I've had one that's been 22 years, speculative development and failure. And all they do is think, so it didn't work, so maybe I have to improve the product. I'll go back and do more redesign. That's death by 1,000 cuts. This whole process will replace hope with bankable evidence. Now, it's not for everyone, I can tell you that now. What I want to do is help you find out whether it could be for you. The first commercial agreement in 100 days, you should, if you want that and you think you can do that, we should be talking. Without any more commercial uncertainty, you've got to ask yourself, can I get to a first deal in 100 days? If you can't, then we shouldn't bother with it because you're not ready. Also, you have to work out what path best suits you. And are you ready or should you wait? That's questions you need to understand that have to be asked. And we do that. I do that in a meeting with you. So what I do is ask you, don't wait another year. You could wait another year, but I'm just going to show you very quickly in 15 seconds what is involved in the level 1 and the fast track program. So you can see here, we've got, we do your partner's level strategy with you. We work with that for 6 months. Commercial modeling, that's that 4-hour workshop. We do it with you. And I ask you the questions and I make all the notes and then build you the action plan. We build you do your sell sheet, you build a sell sheet, partner qualification, 1041. You do the pitch deck of A and B. I've talked to you a little bit about that. We also do due diligence review, and I do the review with it. On your due diligence, we build a due diligence file so that you won't have any delays if someone says, okay, what's the next step? You've got the next step in your hand. We also have those reach out calls. They're 30-minute calls, and you've got any number over the 6 months, wherever you need it. Obviously, you won't abuse it. And we also can, if you wanted to, we can sometimes do a first run. You're in your pitch deck, but I'll do a dry run with you. You actually pitch to me first if you like. But you're going to go out there and do your pitch to people. Total on that is $5,000, but we do have a 6 months of $1,000 a month, which is a little bit more than $5,000, but makes it affordable, particularly if in 100 days you've got cash flow. Having said that, I must be frank with you. If you do a license agreement, you're not going to see cash for 9 months. You'll have a bankable document, but you won't have cash because it'll take them 6 months to tool up for it, and you're getting paid 90 days in arrears. That's at least 9 months. And if those are big companies, they're going to pay on 60 days sometimes. So it'll be almost a year before you get cash in the bank. So just to let you know, that's the sort of thing you're going to face if you do it, even if you do a perfect job. Now, with our fast track program, we do for partner-led strategy, the commercial modeling, but I do the sell sheet with you, partner qualifications. Instead of you doing it all, I do it all. And the reason I do it with you, and the reason for that is I can accelerate the whole thing. Also, on your first pitch, instead of just pitching dry run to me, when you go into your first deal, we can usually get that deal. If it looks right, I'll go in with you. You appoint me to your technical advisory panel, and I come in as a member of that panel to help pitch. Total there is a $3,000 increase. So if you wanted to look at that, it's not a lazy man's way of doing it. I've got to tell you, it's really, if you're dead keen to move this forward or you have a need to move it forward, it's worth an extra $3,000. Now, I can't tell you if it is or isn't. We'll decide together on a call which one, level 1 or fast track is appropriate. Not everyone qualifies for the fast track, and that's intentional. So I just don't give it away. It's a lot of work. So if you're ready for your first commercial deal, level 1 is all about finding that willing commercial partner for you. 100-day pathway to a commercial agreement. No premature patents, designs, tooling, or production that you have to spend. It's a partnership-led thing, not an investor-led thing. It's designed for working inventors and agile R&D teams. If you're small enough, you can do this. And how you do it is pretty easy. You book your commercial readiness call with me, which is this link here, which I'm going to send you at the end of this call. You'll automatically receive an email, a thank you email, and it'll have this link on it. You can make a booking with me. And once you've done that, it doesn't give you a guarantee. It's an invitation only. We have limited spaces. There's no obligation for you to buy anything when you come on board on that call with me, because I just need to qualify you as much as you need to qualify me. But the project itself must also qualify. So if that's something you want to do, that's how we do it. So there it is. I'm going to now stop sharing my screen, and I'll look at stopping my recording so I can